So, good morning, all of you. Today, in this video, we are going to learn what the means of capital structures. The questions arise being a student of MBA Finance or being a student of financial management. We need to study this particular chapter known as capital structures. What the reason? Because this chapter, this topic, the capital structures will help you to design your entire capital or total capital which you are going to invest in the business. So that's why what the proportionate and what the combinations of debt and equity should be mixed up so that we can maximize the overall profit and we can minimize weight, weighted average cost of capital. That's why this topic is very important for each and everyone, the capital structures. So this topic I'm going to discuss and I'm going to describe you people on this particular YouTube platform. So be ready to attend with me and learn the means of capital structures in a very simple way. I think you all are ready. Thank you, all of you. Now, before starting this topic, I'm going to introduce myself. This is Dr. Anil Tiwari, Faculty of Accounts and Finance from the Sage University, Bhopal. I have a 13-year experience in this field or in this area. So I'm going to explain. Now, as we know very well, what the means of the financial management, the financial management is concerned with what raising the financial resources and their effective utilization. Now, the financial management is a tool, technique, and methodology which help you to obtain the source of finance and now is its proper utilization. The questions arise now we have a number of sources are available. But which source of funds now would be better or would be beneficial or would be, we can say, the good for our organization, how we can decide. So this tool now have in our hand, which able to suggest you now in this number of sources, which source of funds could be better for you. So that is one hand. Secondly, it is the most important thing, how we can utilize it. So this subject, the financial management, it's tell you, it's describe you, it's able to make you understand or you are able to take the decisions in this regards, how we can manage our funds for the business activities. So this is a simple line, now we can explain it. So, or simply the people say the financial management, because in the finance, we can impose all the management functions, planning to controlling. So it's become the financial management. So now we are going to or explain you now the second topic. It is known as the capital structure. The capital structures now refers to the compositions of long-term source of funds such as debentures, long-term dates, preferential capital, and ordinary share capital, including reserves and surplus retained. So now we have a, we can say the options of, we can say the financing a capital from these sources, but what would be the ratio could be beneficial for the organizations or as well as shareholders. How we can take the decisions? We can say the which composition or mix up of the, we can say, debt and equity now may be able to increase your profit. How we can take the decisions? Either on the basis of our own assumption or a hypothesis, if we have a experience, so we can easily, we can say the setup, now these things now could be better for the company as well as the shareholders. So now we can obtain or we can raise the funds from that particular sector, but we all are new. We are freshers. We don't know how the funds is managed and how the mix up of this various kinds of capital into the one jar or one box. So this topic will help you to take this kind of decisions. So, so this is the capital structure. Is the composition. It is the combined debt and equity known as the capital structure. What the proportionate of debt and equity at the what level debt and equity should be mixed up. It is known as the capital structures. So next, now then see what I already spoke on this particular platform. Total capital structure of a firm. The total capital, it's cover the two things, the equity capital and debt capital. Then under the equity, it is known as the shareholder funds. So my dear friends, you already know very well what the means of the shareholder funds, which things now we include in it. And the similarly, now the debt capital, we have a debentures or long-term loans. So what the ratio of this debt and equity, at which level we can mix up it, at which level we can combine these two different, we can say the funds into the one jar. Now this capital structure will help you to take this kind of decision. Now say the feature of capital structures, the features of capital structure is profitability. The capital structure must be in such a way that it is increase the profit of the business. Because we know very well the debt fund is the very cheapest as compared to equity. So when we raise the funds, one is the we can say the high we can say the costly funds. It is known as equity, and something is the cheaper fund. It is the name is debt. The mix up of this cheaper funds and the higher funds now at the particular proportionate or in the particular fixed proportionate. So it will definitely increase the profit because we can save the cost of capital. So that is the main thing. That is the main feature of this particular capital structures. Increase profitability because your overall cost, your weighted average cost of capital will be low. Now, second is safety and solvency. The capital structure must be built regarding future safety and solvency. The excess presence of debt capital makes it difficult from the firm not only to pay the annual interest, but also to redeem its debt on the maturity. Sometimes, because of minimizing the cost, we obtain or we raise more funds from the debt. But as we raise more funds from the debt, our risk is erased because on the year wise or either the quarterly or half yearly, we are bounded to pay the interest, the cost which now we need to be paid on that particular day. What we have raised from these various sources. So this is the if we raise a debt and the mix up of debt or the participation of debt fund is at large scale. So again, it will raise the risk of solvency. Either the business can able to pay their, we can say their debt on the particular time period. So sometimes it's become very difficult for the owner to manage this proportionate or the debt, and sometimes because of this more debt, now business can be insolvent. So you want to be safe from the insolvent. Now you need to you need to maintain your solvency ratio. It means debt and equity ratio in the proper proportionate. Now, second is the flexible. The capital structure must change from time to time according to situation in the capital market. Sometimes we know very well the date or the price of debt or the price of equities nowadays we can say fluctuate because the market is not a certain. It is the uncertain or it is the fluctuation is certain. We know nothing is fixed. So according to these are we can say the favorable situations, which thing is the cheaper or which thing is costly. According to that, now we need to be mix up or we need to design this proportion. So capital structure will help you to take this kind of decisions. Now, the second is the control. The main thing that helps the management retain the control over the decision making. It suggests debt should be a preferred over equity whenever additional funds needs. That is the simple things. On the basis of that, now we can control our cost, which incurred on the equity because it is very highly. So we can raise the fund from the debt, so it becomes the cheaper, and we can on the or we can maximize the EPS earning per shares. And the cost of issues and flotation cost is structured in such a way that it reduces the issue cost and the flotation cost as much as possible. And normal, the cost of debt should be lower and as compared to cost of equity. Already I told you and discussed this. The factor affecting the capital structures, we have various factors which are affecting the capital structures. What are those factors? So I'm going to explain here. The nature of business that don't have stable income prefer equity capital, while the business engaged in the public utility prefer more debentures of officials. Now, second, purpose of finance. We need for productivity purpose, debenture unproductivity equal to the equity. Technology. Firms use capital intensive techniques. Debenture or firms use labor party intensive the equity. Sometimes the if firm it is based on the technology, there should be a raise the debentures and the cap. If the fund is labor intensive, that should be obtained, or that should be, we can say, the raised fund from the equity. And the requirements of investors. Investors who want high risk now can prefer the equity. A firm needs less risk, prefer debentures or preferred shares. Nature and size of the firm. The size larger than issued debentures or say a rich borrowed money easily, while size is small, then company preferred on company as a source of income. It means your retained earning.
Thank you.
So thank you all of you for listening me with patience. I hope now you are able to understand, or you can easily understand or understood what the means of the capital restrictions. In the next video, I will teach you or will explain you more on the capital restrictions. So thank you very much. Thank you for your cooperations and watching this video. We will meet very soon. Thank you.